This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Sentiment readings and headlines tell us the skies are darkening, but maybe they're passing clouds, or at least in the next town over. Financial stresses are minimal, earnings are good, and so far we keep spending. Up next, let's talk about being prudent and disciplined instead of fearful and reactionary. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. It's been quite the rally since the lows of late March. In fact, one of the largest rallies we've ever seen in our lifetime. According to FactSet, going back to 1950, the run that we've had is the 20th biggest 9-week run that we've ever had. So what's that? In 76 years, the 20th biggest 9-week gain. You might say, well, what does that portend about the future? Well, past performance is no guarantee of future results, as we all know. But success tends to breed success. I've talked about this a million times on this show, right? People should not fear strong markets, but people do. Again, if you go back to 1950, according to FactSet, the above average returns of almost 27% is what you've seen when you've had rallies like this. Double what you normally see on a 12-month basis. So again, I have no idea how it's going to turn out this time around, but history suggests this is a positive sign, not one to be feared. The folks up at Ritz-Alt Asset Management noted that during the 1983 to 2000 bull market, there were 493 new all-time highs. They were all bullish. They were all a bullish indicator, except for the very last one, the one that ultimately yielded to the dot-com bubble. But that was 17 years of new highs, but getting more new all-time highs. However, I will say, kind of the cautionary part of this is it has been thin. It has been narrow. I talked about this a couple weeks ago. We've seen a little bit of improvement in market breadth, but not that much. In fact, just as of Thursday of this week, we had 6 sessions in a row where the index posted a positive return, but there was negative breadth, meaning there were more decliners than advancers. Okay? Again, according to FactSet, that's very unusual. Going back 30 years, the S&P 500 has never risen for 6 straight days with decliners outnumbering advancers. And I know it's a very small data set, right? Just 6 trading sessions. But it's reflective of really what we've seen since late March, where it has essentially been a tech rally for the most part, right? Yes, some other things have gone up to a degree, but it's been mostly tech. In fact, technology up roughly, give or take, about 40%. 40% over the course of the last 9 weeks. That's, again, not only rare, but also reflective of the fact that there are several important sectors in the market that really haven't done much of anything. In fact, I was just looking, consumer discretionary, healthcare, and financials, which in aggregate are a big percentage of the market, all still firmly negative year to date. Negative. Okay? So just think about that. We've had the strongest 2-month stretch for tech by my math since the great financial crisis. And according to Bloomberg, the S&P 500 technology sector's relative strength, which is a sort of a technical term, but relative strength versus the broad market, highest level in history, even surpassing what we saw at the peak of the dot-com bubble in March of 2000. Highlighted by chip stocks. The semiconductor index is up 160-some% over the last 12 months. 160%. I mean, pretty astronomical. In fact, that index, that semiconductor index, I did the math this week, up almost 70% combined in April and May. So you've had this kind of meteoric rise in a very small slice of the market. Okay, well, God bless you if you have a lot of exposure there. But I would say that, you have to be a little bit careful, right? If all the performance is coming from a pretty small slice of the market, the obvious inference is that things can go the other way. And of course, we saw that, right? Late last year, January, February, don't forget, just a few months ago, we had 180-degree different conditions where tech was the worst place to have your money, and performance was coming from where? Financials, healthcare, industrials. Who knows if we'll see that type of rotation again, but we would certainly, I think, any portfolio manager and probably any individual investor would welcome a more balanced type market. So think about that. I would also say, be careful how you evaluate managers. And by managers, I'm not talking about us, okay? But if you're looking at mutual fund managers, for example, it's going to be very tempting to, kind of latch on to managers who are heavily focused on tech. I mean, that's just the reality of it, right? Because what do most individual investors do? You look at trailing performance, trailing 1 year, trailing 3 year, trailing 5 year performance to decide who you're going to invest with, right? Or let's say you're allocating your 401k. That's how most people evaluate where they're going to put their money. I'm not judging, but that's what most people do, right? But here's the problem. Again, if most of the performance is coming from a small slice of the market, those are, of course, going to be the best performing managers. It's not necessarily an evaluation or proper evaluation, I should say, of the quality of the manager. So don't get me wrong, I'm not slighting people who are heavily into tech. It's been the right trade. But you could have a very good manager, particularly value managers. I'm not going to name specific names, but I know a lot of managers who I have great respect for that have had wonderful long-term track records and significant alpha when the rest of the market isn't doing as well, that have underperformed in the last 12 to 24 months, and certainly year to date. Focus more on process, long-term track record, than maybe some of the short-term momentum trading. I don't mean to get kind of distracted on that point, but it's something that I'm seeing a lot. So what are some of the takeaways from the current environment? Well, the one that I have harped on ad nauseum, I should say, for years, is try not to get too caught up in geopolitical events. I've talked about this a lot. I think Chase has as well. I know that's all we're reading about, right? Every headline, every cable TV utterance is about geopolitics, and politics for that matter, and certainly geopolitics as well. It's a very difficult way to invest. I think one of the biggest mistakes individual investors make is they draw a straight line between geopolitics to the economy and the economy to the markets. Those are not straight lines, as we've seen so far this year, and quite frankly last year too, when the tariffs came out. People drew a straight line from that to the stock market. Well, stock market did something very different than what a lot of people thought based on the tariffs that were imposed. So far this year, what was the rhetoric back in March? Virtually I don't think I'm exaggerating here, almost every quote-unquote energy expert that I heard on CNBC or Fox or MSNBC, whatever you listen to, right? They were talking about $200 oil. By the way, we could still have $200 oil. I don't know what the future holds, but based on what we've seen so far, everybody was talking about $200 oil. And it was actually forecast by many that I heard as almost inevitable, right? Well, we never sniffed $200 a barrel, right? And as it stands, we're somewhere in the low 90s. Same thing happened in 2022 when the Ukraine war broke out. $200 a barrel oil was inevitable at that point too, according to many. But there's a big difference between the headlines and what the markets actually do, how the markets react to that. There's also things that you don't necessarily know about when you read the initial headlines. So, for example, in this case, we're finding out that China's reaction to this is a lot different than what people thought. In fact, I just read this week. Maybe one of the biggest reasons why oil hasn't spiked is that China imports have dropped significantly. So it's a little bit opaque as to what China's doing, but whether they have big storage facilities, bigger than what people thought, or maybe they just stopped aggressively buying to build those stockpiles, maybe they're using coal instead of oil, maybe they are cut the amount of crude that they're processing, changed the mix of what they produce, who knows? But that was something that was not taken into account as well. So it's not just, misunderstanding the relationship between geopolitics and the markets. It's also misunderstanding what is actually going on behind the scenes, right? Both of those things. But the bottom line is, even if you are right, even if you knew about China, even if you're right about the supply and demand dynamics, you still might be wrong about the market implications. That's the biggest takeaway. So what should we focus on? Well, again, I've talked about this ad nauseum, but I'll keep talking about it because it's what's the most salient at this point. We have never seen earnings growth this strong outside of post-recessionary rebounds. That's essentially the bottom line. The numbers are pretty unbelievable. We're about, 97, 98% of the way through first quarter earnings reporting. Analysts are expecting 29% growth in the S&P 500 earnings on a year-over-year basis. 29%. That's according to FactSet. Now, you can strip out some one-time stuff. Maybe it's closer to 23, 24%, but still. That's like twice, I'm not exaggerating, that's twice what was expected less than 5-6 months ago. And if you think it's all buried in the Magnificent Seven, it's not. If you look at the other 493 names in the S&P 500, still on track for almost 18% year over year. Again, this is FactSet data. Where is that coming from? A lot of it's, of course, profit margins, right? We've talked a lot about how even with all this pressure, tariff pressure, interest rates going up, oil prices going up, all these input costs going up, companies are more profitable than they have ever been, at least in modern recorded history. Again, strip out the Magnificent Seven, profit margins have gone, according to FactSet, from about 10.5% about 5 years ago up to almost 18%, 17.8%. Excuse me. Let me back up a second. 2021, they were as low as 7%. This most recent quarter, up to over 13%. Okay, I was looking at earnings growth. This is profit margins. 7 to 13.4% in about 6 years, a doubling. That is pretty unbelievable, right? And that accounts for all the COVID era too, right? So even when inflation was running at 9% a few years ago, you still had that trajectory. And you might say, "Oh, Simon, you can fake earnings. You can kind of massage profit margins." Well, you can't fake sales. You can't fake revenues. Every single sector in the S&P 500 is expected to post a year-over-year increase in revenue growth. And overall, in aggregate, expected to be almost 11% year over year. So, bottom line, folks, let's not underestimate corporate America's ability to weather storms and to adapt to changing circumstances. Does this mean everything's rosy? Of course not. I'm going to talk about the economy in a minute. And short term, I would expect there are plenty of reasons to expect some volatility. We've talked a lot about the fact that midterm election years are far and away historically the most volatile of a 4-year presidential cycle. Okay, so we have that to look forward to between now and November. And of course, this time around with the polarization we're dealing with, and we all know about, Trump supporting certain candidates. And, we know all about the permutations and combinations of what could happen. But we also have a new Fed chair. And history suggests, I was reading something, this was in Bloomberg the other day, history suggests that the markets tend to, quote unquote, test new Fed chairs. You often see within the first 3 to 6 months of a new Fed chairman's term, volatility in the market, often a drawdown, on average, high single-digit drawdown. This is going back about 50 years. So again, these are not predictions, but just reasons to think that, hey, maybe we pause at some point. But still, the longer-term trends look okay, quite frankly. The way I see it is you can have sort of a base case, but your base case should probably not be at the extremes, right? If your base case is a 50% drop or a 50% rally, it's kind of hard to build a portfolio that way. You have a base case of what is a logical outcome, but then have contingency plans if things do a lot better or a lot worse than you expect. I think that's a good way to go through life in general, but certainly it's a good way to be an investor. But I want to switch gears a little bit. Generally don't talk about the economy too much, at least at kind of a macro level. And the reason for that is the reason that I laid out a couple minutes ago. It's because you could be right on the economy and wrong on the markets. And by the way, most people are not right on the economy, but let's say you were right on the economy, does not mean you're going to be right on what the S&P or the Dow is going to do. Even if you were right, you don't necessarily get the timing right, because they're often not in sync. But I mentioned how revenue growth is expected to be up 11% year over year, according to FactSet. Well, companies can massage the bottom line by efficiencies, harnessing AI. But, if you're going to grow revenues, you do have to have some economic backing for that, right? Hard to grow revenues at 11% if we're in a deep recession. So let's look at the economy just briefly. And the thing that kind of made me think about this and made me want to talk about this is the consumer sentiment readings that go all the way back to the 1950s are the lowest ever recorded, which, if you think about it, is fairly stunning. So we're at the lowest level of consumer sentiment in the past 75 years, much lower than the great financial crisis when the S&P went down 60%, lower than the aftermath of dot-com bubble popping and 9/11, lower than the 70s when mortgage rates hit 20%, interest rates were in the teens, lower than COVID when the whole economy shut down. But here we are. It's kind of unbelievable. I mean, the reasons, I don't know the reasons necessarily better than you. I mean, there are a lot of things that people can point to. Certainly inflation is one of them, right? That tends to be the lightning rod that affects people's psyche more than anything else. Housing costs, AI worries, AI coming for our jobs, wealth inequality, that all factors in. Certainly the polarization in politics, right? Half the country thinks that we're going in the wrong direction now. It was a different half that felt we were going in the wrong direction when Biden was in office, right? We know how that goes. But the other thing is, I think that I would just point to, it's the constant barrage of instant access to negativity. That's the way I would put it. If there's something going wrong in the world, you know about it. I mean, I went down a rabbit hole the other day, reading and listening about these, cave divers who died in the Maldives, right? 20 years ago, we didn't know about that story. It was on page 12 of the Washington Post or the New York Times or whatever you read. Now it's instant access, and particularly for young people, right? Young people are growing up as cynics. I hate to say it that way, but they are. But that's what kind of got me thinking about, okay, well, the sentiment readings are lousy, but what is actually happening? Well, you get a different story, quite frankly, if you start to do the math. And I read a really good piece from Trend Labs. They looked at some of the data kind of that we traditionally monitor for signs of stress. Most people follow the S&P to some degree, right? Follow the stock market. But if you're really looking for a reading of a potential kind of canary in the coal mine, the beginnings of a real economic stress, there are other indicators that are more reliable. One is the Fed Financial Stress Index, which is kind of a pressure gauge for the financial system. Banks, lending markets, funding markets, credit conditions all feed into that index. And historically, it spikes when things are breaking, right? Like during the great financial crisis, the COVID crash. Right now, according to Trend Labs, it's sitting below zero. So there is literally no indication of financial stress. Now, doesn't mean there isn't financial stress somewhere, and of course for some people, but at the macro kind of data level, not seeing it. I also pay a lot of attention to credit spreads. And what I mean by that is the yield on corporate bonds, particularly high-yield bonds, below investment-grade bonds that are the least creditworthy, relative to safe bonds like treasuries. The wider those spreads are, the more indicative that is of possible, or at least worries about defaults, recession, economic weakness. Those spreads are at the very bottom of the historical range. In fact, just a few months ago, they were the lowest ever recorded, but they ticked up a little bit, but still towards the bottom end of the range. So these are not the types of things that you would see if we were on the precipice of an economic collapse. Doesn't mean that things can't get worse, doesn't mean that a recession can't happen. It just means, again, going back to that kind of base case idea, I don't think it can be your base case that the world's about to fall apart, or at least the U.S. economy is about to fall apart when it's not being reflected in these indicators, okay? And I would say bull markets generally don't die when financial conditions are calm. That does not preclude corrections, pullbacks, drawdowns, but the overall trend tends to not fall apart without that type of credit stress. What are some of the other things I'm looking at? Well, one is consumer spending. That's probably the biggest thing, right? And consumer spending, according to BEA data, ticked up again. I haven't seen the May data yet, but in April, up 0.5% month over month. I think that's particularly relevant because oil went up, 30, no, more than that, over 40% in March and April. So that's consumer spending still went up even though that was happening. Credit card spending is holding up. In the week ending May 23rd, according to BEA, it was up almost 6% year over year. Personal consumption expenditures up. And then sort of anecdotal data is pretty strong as well. I was reading from Larry Adams here at Raymond James that restaurant bookings up 13% year over year. This is for May. AMC, the movie theater operator, strongest May attendance since 2019. Again, I know that's kind of, anecdotal, but where you are seeing stress is at the lower end of the income strata. Dollar General, for example, just came out this week, talked about how lower income consumers are cutting back on purchases. Walmart said something similar a few weeks before that. You are seeing some rising credit card delinquencies, student loan defaults. Those are things, I hate to say it this way, but it's true, tend to affect the bottom half of the population from an income perspective more so than the top half. So it's not that I'm not concerned. I get paid to be concerned, something we follow very closely. But again, I'm talking to a fair number of clients and potential clients really thinking that the economy is on the doorstep of a deep recession. And again, can't say it won't happen, can't say things can't get worse, but there just isn't a lot of evidence for that, anecdotal or hard data that would suggest that's the case. So just think about that in the context of whether you really need to significantly change your asset allocation. Maybe you rebalance. Nothing wrong with taking some risk off the table, nothing wrong with taking some profits, but to significantly change from, just throwing out an example, 70% stocks to 5% stocks or getting out of the market. Seems to me there's not a really good case for that. The last thing I just wanted to mention from kind of an economic perspective, a lot of talk obviously about interest rates going up. 30-year Treasury up around 5%, 10-year Treasury up around 4.4 and change from 3.9 before the war broke out. I think the jury's still out as to what that means. I mean, there's a lot of talk about the markets reacting to, all the debt that we have. Well, maybe. It could just be a normalization is the way I kind of think about this. Remember, we had kind of ridiculously low rates for an extended period of time, right, over the last decade. And then we also had well below inflation trend. I mean, the post-World War II average is roughly 3%. We were in the low twos for much of the last 10 to 15 years. So maybe it's just the markets recalibrating to more of a 3% normalized run rate than a 2% normalized inflation run rate. That could be one suggestion. The other thing I would say is higher interest rates are also correlated with better expectations for growth, or at least expectations for better growth, I should say. I was reading a piece from 314 Research, and they made that correlation that interest rates tend to correlate pretty strongly with S&P 500 sales. So I mentioned earlier, revenue growth is expected to be up 11% year over year. Longer-term interest rates are going up. So maybe that's kind of what's going on rather than the doomsday scenario that the bond market is suddenly concerned with the debt that we have. Just just something to think about. I would also say, and I mentioned this 2 weeks ago, the relationship between higher interest rates and the stock market is nowhere near as negative a picture as some people think. Some people think, oh, geez, interest rates go up. That means we have to pay less for future earnings. That collapses multiples. That leads to a bear market. History suggests that is not the case. And there's no real data that supports that. Doesn't mean you can't have corrections. Sometimes when you have rates going up very quickly, that is the trigger for a correction. But according to Ritzelt Asset Management, going back to 1950, they basically looked at when the 10-year Treasury rises 1% or more. We've only gone up about 0.5% in the last few months. But let's say it does rise 1% or more. Yes, you've had drawdowns, but over the life of the cycle, which is generally 2 to 3 years, 100% of the time, according to their math, we've still seen positive returns in the S&P 500. And what's the reason for that? Because, yes, interest rates can be going up. Yes, valuation multiples could be coming down. But if earnings growth is going up at the same time, you can still have much higher stock prices. And that's kind of what's happened, right? So you can easily have a situation, and, in fact, I was reading Nick Colas. He's a financial blogger who I respect. He pointed out from 2015 to 2019, the U.S. Treasury note yielded an average of 2.27%. During that period, the S&P's forward price-to-earnings ratio was between 15 and 18 times. Well, then he noted, now the yield is at close to 4.5%, yet the forward PE is also much higher at 21 times earnings. But the reality is the earnings growth has outpaced, the valuation expansion. Okay, so that's how you can have higher prices. So just keep that in mind. I think the broader point I would just make is you want to be careful not to look at any one economic variable in isolation. So if you just look at interest rates or just look at valuations or just look at inflation without considering the overall context of revenue growth, sales growth, which I guess that's the same thing, but earnings growth, profit margin growth, then you can come up with a very misleading idea of when the market's cheap and when the market's expensive. All right, I'll leave it there. As usual, I do want to just bring you up to speed on a few things from an individual stock perspective, including a stock that we're buying in many of our client portfolios for the first time. So I want to talk a little bit about that back in a sec. Remember when AI stocks went up every day and massive tech spending was rewarded? How do you separate an abrupt shift in sentiment from business reality? Are now weak tech names opportunities or to be avoided? Tune in every week as we discuss the latest financial trends and what investors need to know. To filter out the headline noise and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Just want to bring you up to speed on a few individual names. These are names that I own personally in my own accounts and that we also own in a number of our client portfolios. So that is a conflict of interest. So keep that in mind. I would also just ask you to remember that these are not research recommendations. You need to do your own due diligence and own research. I'm just offering some ideas for you to think about. If you are a shareholder of Danaher, You may remember that they spun out a company a couple years ago called VLTO, VERALTO, VLTO, symbol VLTO. It is not a well-known company, but it's one that occupies a space that, quite frankly, isn't getting a lot of attention right now. Somewhat of a boring space, but also a space that, quite frankly, is not overly cyclical, not going to be subject, everything's subject to the economy to some degree, but for the most part, does not have a lot of economic sensitivity, not a ton of sensitivity to, AI spending and some of the other kind of focuses du jour as well. Basically, almost 60% of their sales is in water quality and water quality testing, okay, which has a lot of application. They have a multinational business. They're around the world. The other 40 to 41% of sales is in product quality and other types of testing, but specifically testing related to food and packaging. So this is a very sort of, again, resilient, non-cyclical business with fairly predictable, free cash flow, fairly predictable margins. And VLTO is kind of at the center of it. Almost, going back to the resiliency, almost 80% of their sales overall are exposed to water, food, and pharmaceutical end markets. So those are three markets that are going to be pretty stable in an economic downturn. I'd note even during the financial crisis, the great financial crisis, they only saw a low single-digit decline in their revenues. And that was, one of the worst economic downturns since we've ever had in the last 100 years, certainly since the Great Depression, okay? 60% of their sales are recurring, meaning they're on contracts. So you're not going to see a ton of volatility in their revenues on a quarter-to-quarter basis, high degree of predictability. By the way, this data is from FactSet. I would also say remember, this is spun out of Danaher, and what is Danaher known for? Superior management execution. So they've had a track record of steadily expanding margins, improving efficiency. They actually guided just recently in their most recent quarter to 35% operating margins going forward. They also are very much an asset-light, kind of model. This is not a capital-intensive business, so they generate a lot of free cash flow. It was almost 99% of net income last year. So very interesting business, pretty broad customer base, roughly 85% of global consumer brands, 75% of global pharmaceutical companies are in their clientele. And I read, again, from FactSet, 90% of packaged items in North America or a West European supermarket have likely been touched somewhere by one of their testing devices. But the reason I'm mentioning it now is that the shares have not done well this year, down maybe 12, 13%. Hard to know exactly what it is. Some of it's just investor interest. As I mentioned at the top of the show, virtually all money the last couple months has been flowing towards technology. Water treatment is not sexy and is not capturing a lot of attention. They also tempered some of their short-term guidance from a margin perspective in exchange for raising their guidance for 2027, but that may have caused a little bit of weakness as well. From a valuation perspective, again, according to FactSet, this is the cheapest that they have traded, certainly since they were spun off from Danaher a couple years ago. But if you break out kind of the parts from the whole, maybe it's the cheapest they've been in well over 10 years, down to about 19 to 19 and a half times next 12-month earnings. By the way, there is a little bit of a AI potential trade here because if you look at what data centers need, they need ultra pure water. They're not running water out of the tap. Ultra pure water to run their systems and their mainframes there. So Danaher is actually, I should say VLTO is actually getting a little bit more into that space. So there may be sort of a backdoor AI trade there, but I don't want you to think of it that way. So VLTO is, again, an interesting company. You may, if you're a Danaher shareholder, like I said, you may already have it in your portfolio, but it would be a small position relative to your Danaher position. If you do not own Danaher or who've never owned Danaher, it might be sort of an interesting out-of-favor sector to think about. So do your homework on VLTO, see if it makes sense for your situation. Also wanted to mention another kind of out-of-favor, non-sexy company called Markel, M-A-R-K-E-L. You may be familiar with Markel. They're often referred to as a mini Berkshire Hathaway. Very kind of similar model. They have a very robust insurance division, mostly property and casualty, like Berkshire Hathaway. And then what do? They take profits from those insurance operations as well as the insurance float, right? Those are the premiums that have not yet been paid out in claims. And they buy other businesses. We all know that Berkshire has done that, right? Berkshire has bought businesses for years. Berkshire just bought another home builder the other day. Markel has done the same thing. Again, it's nowhere near the size of Berkshire, but similar concept. In fact, there was a really good article in Barron's on them. I guess it was May 11th. They were saying that portfolio produced about $850 million in operating profits and could be worth close to $10 billion. This is according to Barron's. This is their math, not mine. That's about half the market value of Markel, so just in those operating businesses. But the other thing I would say, just from their insurance perspective, they brought in a new insurance leadership, guy by the name of Simon Wilson. He took full control of the insurance business last year, so he's only been on the job, I think, less than 9 months, and has already significantly improved their profit margin. They showed a combined ratio of 93% versus 96% in the previous year. Remember, a combined ratio is expenses and losses as a percentage of premium, so the lower, the better. So they've been trending in the right direction with that core insurance business. But I think the reason I'm kind of bringing up Markel today is that the valuation is interesting to consider. They're trading roughly, give or take, about 1.2 times their book value. That's below their average book value of about 1.4 times over the last few years. They also trade for only 13 times this year's operating earnings. This is FactSet data. They have their own intrinsic value estimate of about $2,900. Take that with a grain of salt, but that's, 60-70% higher than the current stock price. And if you look at their competitors, companies like Berkeley, RLI, other pure insurance companies, they're trading for like 2.5 times book value. So I think in the short term, it's actually these operating businesses that Markel has that are kind of dragging down their valuation, and maybe the new insurance team hasn't gotten enough credit yet from the street. But overall, I think Markel, again, it's not a chip company, it's not a hyperscaler, it's not sexy, but if you're looking for something, and I put VLTO in the same camp, that gives you some different types of exposures, less correlated than sort of the current environment, that maybe had the opportunity to do a little bit better in a different type of environment, Markel and VLTO kind of stand out for me. So take a look at them. Remember to do your own research and make sure it's right for your particular portfolio. I think I'm going to leave it there. There's obviously a lot going on in the world, and we will continue to keep you informed. Coming to the tail end of earnings season, first quarter earnings season, but there are a couple names that just reported that we'll try to update you on over the course of the next week or two. Chase Hinderstein will be back with you next week. I hope that was helpful, and as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.